Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Oil ticks higher as the US and Iran exchange strikes after the downing of an American helicopter over the Strait of Hormuz. Stocks resume their declines, with tech leading losses in Asia ahead of today's US inflation print. Plus, concerns over the outlook for private markets dominate the SuperReturn conference in Berlin. We'll be hearing from top deal makers throughout the day. Well, a very good morning. Here is the picture in markets. Tech sliding again this morning, so weighing on stocks and futures. South Korea's Kospi is down 6.3% as things stand, dragging the broader index down 2.5%. Nasdaq futures lower 0.8%. We had a choppy session yesterday, so S&P E-mini futures down 0.5%. Chip stocks under particular pressure, and Euro Stoxx 50 futures even now in the red, down 0.2%. So as you can see, risk appetite remaining fragile all around the world this morning. Now flip cross asset and you can see the geopolitics playing out as well. Brent is up 0.6% at $91 a barrel. This, of course, not helping stocks either, but it's after those fresh US strikes on Iran. Counterintuitively, perhaps, gold slipping below $4,200 an ounce. This on the US-Iran clashes as well, slumping deeper below that 200-day moving average on the inflation risks and the possibility of rate hikes. And indeed, you've got Treasury yields there on the right, climbing in advance of that US CPI print, up 2 basis points at 4.5% on the 10-year. Expectations really mounting that the Fed is going to have to raise rates to fight inflation. And indeed, the 2-year yield is at its highest in over a year. Now let's take a look at the risk events on the docket for today. At 7 a.m. London time, top of the hour, we'll get Norway and Denmark's inflation reports, followed at 1:30 p.m. London time by the US CPI report. Of course, we had that blowout May jobs report earlier last week, fueling bets on Fed hikes. Does this challenge that view? Is a big question. Then at 2:45 p.m. London time, the Bank of Canada will make a rates decision, expected to keep them on hold. Well, let's set you up for the day ahead. We begin with oil a touch higher on another escalation in the Middle East. Iranian state media saying that the country has hit 21 US aerial and naval targets across the region, including sites in Jordan and Bahrain. Now, that's in response to US strikes that were launched against Iran on Tuesday after President Trump blamed Tehran for shooting down an American military helicopter off the coast of Oman. For more, let's go to our Bloomberg Horizons Middle East and Africa anchor, Abir Abu Omar. She joins us now from Dubai. Abir, I have to say, ceasefire, what ceasefire? Just bring us up to speed on the latest. Good morning.
Good morning, Lizzie. Yeah, it definitely feels like that is the sentiment this morning, with a fresh round of strikes between Iran and the U.S. directly. Now, what President Trump told ABC News yesterday was that he has to really respond powerfully to Iran downing an American helicopter yesterday. And that is what we saw happen overnight, where U.S. forces had attacked areas in Iran. They didn't say what they were, but Iran state media afterwards came out and said that they were areas in the Qashm Island, for example, that were suffering from explosions, 6 of them, as a matter of fact. Iran retaliated a couple of hours earlier against U.S. bases, the 5th Fleet in Bahrain, also Kuwait, also Jordan. And so we're seeing this uptick in hostilities. And Lizzie, this follows a week of hostilities that we saw between Israel and Iran, and then Israel's actions in the southern part of Lebanon, where it continues to have its deepest incursion in 25 years, since the year 2000, as a matter of fact. So when you talk about ceasefire, that is something that everyone is questioning. President Trump maintains that a ceasefire truce, or the MOU, this interim deal that we've been talking about over the past couple of months, to reopen the Strait of Hormuz and establish further ceasefire for the next 60 days to then discuss more concessions. He maintains that this is still ongoing. Sources tell us that the wider truce talks are actually intensely going, and that Pakistan is still mediating. It doesn't feel that way across the Middle East this morning, however, Lizzie.
Yeah, would Washington like us to look through the strikes? Because it does seem that they're using more calibrated language when it comes to discussing the back and forth militarily at the moment.
You're absolutely right. Look, the CENTCOM response to the attack that they had overnight was that it did feel very calibrated. It did feel like the language that they used suggested that this is a one-off, that this is a retaliation against the attack by Iran. And look, President Trump last week did say that one of his red lines is going to be the death of American troops. Now, that did not happen this time around. Both crew members on the helicopter that was attacked were safe. They did not die, and so that was not crossing Trump's red line. But he did suggest that an attack against American troops in the region would constitute a response by the United States. Now, Iran's Foreign Minister Abbas Araghchi came out and said that, well, it constitutes a red line for Iran as well to have American troops circling around the country. And so this tit for tat has seemingly been going on over the past couple of weeks. We wait and see what further action the U.S. takes when the U.S. wakes up and what further comments President Trump has. But for the time being, it looks like the calibrated attacks against Iran and then Iran's retaliation seem to have stopped for the time being, Lizzie.
OK, Abir, thank you for the update. That's Bloomberg's Abir Abu Omar. We'll be back with Horizons at 5 a.m. London time. Well, let's see how all this is playing out in markets. We can go to Asia now. Winnie Sue's in Hong Kong for us. Winnie, it looks like you've got geopolitics and tech as headwinds this morning.
Yeah, exactly, Lizzie. We are seeing investors turning more cautious, especially ahead of that U.S. CPI numbers, because we did get pretty hot prints for the U.S. jobs data last week, reinforcing the Federal Reserve's rate hike path ahead. And that is really weighing on markets today as we see MSCI Asia extending losses to over 2%, with declines led by South Korea's Kospi index at one point down as much as 6%. Remember, it was up actually 8% yesterday. So lots of volatility in the world's best performing stocks so far this year. Now, when it comes to the bright spot, it's actually in the world's worst performing stock gauge so far this year, which is actually in Indonesian stocks here, up 2.3%, extending gains of as much as 7% yesterday after the Bank of Indonesia announced a surprise rate hike to support its currency. And hence, you can see that the Indonesian rupiah strengthening for a second session. Now you flip aboard, we take a look at Japanese assets because, yes, tech is a drag. Hence, we are seeing tech-heavy Nikkei 225 underperforming the broader topics gauge, while the bank index in the topics is actually outperforming on expectation for the Bank of Japan to raise rates. And that expectation is also reinforced by today's strong PPI numbers. We are looking at PPI numbers up 0.9% compared to the previous month. And in fact, when it comes to the annual base, it's actually rising at its fastest pace in about 3 years. Bond space, we are looking at a weak demand coming out from the 30-year bond auction at its weakest level since about a year ago because of the recent decline in yields, dampening interest in the investors as well. Now, flip aboard as we take a look at the CPI and PPI numbers from China. Now, that is a bit of a different picture because we continue to see that divergence in the PPI and CPI. Here for the producer inflation numbers up about 3.9%, and that is a pickup from the previous month. And when it comes to the CPI numbers, 1.2%, in fact, missing estimate of 1.3%. And it goes to show how manufacturers have been struggling to pass through these higher input costs to the consumers, and that this is also complicating the reflationary picture in China. Back to you, Lizzie.
Winnie, thank you. That's Winnie Sue in Hong Kong. And staying on the inflation data, we're going to get another batch of it today, this time from the United States. The print expected to show inflation ticking above 4% year on year, and that reading could add more pressure for the Fed to hike rates, with options markets showing bond traders piling into bets on a move higher as early as September in the wake of Friday's hotter than expected jobs report. Let's bring in Bloomberg's Ven Ram, MLive strategist, of course. Ven, what's it going to take for this CPI report to change the narrative when it comes to Fed hikes? Good morning.
Morning, Lizzie. I think that, the markets will be riveted on how much of an overshoot there is relative to the forecast. I think that 4% is pretty hot. It'll be the first time in 3 years that we get a number like that. And it'll immediately call into question the Fed's credibility, because they're in their March report, dot plot and summary of economic projections, they estimated that a core PCE would be 2.7%. A reading above 4% would, of course, be inconsistent with that 2.7% forecast. So the question is, how much of a upward revision are we going to get to the summary of economic projections next week when the Fed meets? Of course, we don't know very much about Kevin Walsh yet. I mean, he may do away with the dot plot and the summary of economic projections completely, and that is a risk that the markets are aware of. I think that, the markets are thinking that, look, even if a hike comes, it will come only in September, as you mentioned, Lizzie. But I think the risk is that, you need to watch the 30-year yield here, because it's already hovering around 5%. And if the Fed gives an indication that, look, they're willing to ride this out, and remember, Kevin Walsh has said that he's more interested in the core trimmed mean inflation, meaning if you remove all the outliers in inflation, what you get is a docile inflation print. That, of course, fools nobody. Definitely not the long-term investors, and they will demand a higher inflation risk premium to hold the 30-year maturity. So that's the maturity that I'm keenly watching after today's inflation data.
To say nothing of the pressure on Kevin Walsh from President Trump to cut rates, Ben. But I also want to put this in a global context. I wonder how different the Fed's inflation challenge is to that of the BOE and the ECB. It seems strange that you've got more hikes priced here in Europe when the growth outlook is weaker.
Yeah, absolutely. I think that, unlike the Fed, it pays to keep in mind that the ECB is a single mandate central bank, meaning its core focus is inflation, not so much about growth, whereas the Fed has both growth and inflation written into its mandate. So I think that the ECB is going to be raising rates. I think that the markets are thinking at least 2 rate hikes this year. And if the ECB delivers along those lines, I think the inflation will be very well controlled, because they're projecting, mind you, inflation will be 3.5% this year under the adverse scenario. So I think that they want to get inflation, they mean inflation target of 2%. When they say it's 2%, they actually mean it, unlike some of the other central banks. But when it comes to the UK, it's a slightly different story, Lizzie, because, the Bank of England has missed its inflation target for the better part of 5 years now. And if they're going to look through the second round effects and wait for the second round effects to show up, I think that'll tell adversely on inflation in the UK, which is why I think that gilts have been coming in for some severe treatment, especially at the long end. So I think that that's a concern as far as the UK is concerned.
Ben, thank you very much. That's Ben Ram, Bloomberg MLive strategist, ahead of that US CPI print later this afternoon. We're still ahead on Daybreak Europe. Private markets in focus as the industry's elite gathers in Berlin for SuperReturn. We'll be speaking to Julian Salisbury, Co-CIO at 6th Street, later on in the show. But first, Anthropic releases its latest Mythos AI model, and we'll bring you the details along with some of our exclusive interview with the company's CEO. That's coming up next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:15 a.m. here in London. Well, Anthropic has released its latest Mythos model, Fable 5, with one major caveat. The AI will reportedly be blocked from responding to queries related to cybersecurity and biology. The rollout will also be joined by Mythos 5, a version of the same model without such guardrails, to be used as part of its Project Glasswing initiative. I'm joined now for analysis by Bloomberg senior strategist Neil Campling. Neil, this is quite confusing. Just talk us through what Anthropic's strategy is here. Is it just about getting ahead of OpenAI ultimately?
I think that may be one of the reasons. Obviously, there's a battle to come to market, but also in terms of showing the highest growth possible for these businesses. So if they can come with new tools and new products that they can then charge for, it helps in terms of that growth rate. And what they're talking about, the launch of these new products, is that they're able to do, they gave examples yesterday, where the tasks they can perform in one day had taken a team of developers at Stripe, for example, 2 months to try and achieve the same task. So trying to show these tools as being very efficient for specific tasks, but then also removing some of those issues around cybersecurity, because they had found flaws previously in other cybersecurity models, which had been uncovered, hadn't been detected for multiple years. So they want to prevent those potential tools being used to prevent bad actors from getting hold of these tools.
Also on Anthropic, interesting that Google, who of course was one of Anthropic's earliest investors, is now increasingly backstopping the financing that underpins data centres for the startup. It sounds very complicated, this financing web. It sounds like they're complicating it even more. Is it just to try and make money at every stage along the way?
I think that is part of it. We forget, maybe there is some worries about these circular arguments in terms of the way these financing and funding rounds go, but actually, Alphabet has been a really smart investor in terms of the money it's made. So let's think back to Alphabet being an early investor in Anthropic. They invested $300 million to get 10% stake in the company at a $3 billion valuation. Now, based on recent reports, that means they've made more than 300 times their money on that investment. That 10% today, in theoretically, would be worth nearly $100 billion. So huge return. So the backstopping on these valuations will have already made a significant return on those original investments. So AI is expensive. You need the backing. Google and Anthropic are basically having a business relationship as well as a funding relationship. And Google, as the investor, has made considerable returns already on what they've invested in this platform.
OK. Neil, thank you for the context. As always, Bloomberg's Neil Campling there. Well, Anthropic's CEO says that AI will make the software industry larger, not smaller, although firms that don't adapt will disappear. Dario Amodei spoke exclusively to Bloomberg Originals about how the company's working to align its business model with its values.
If you pick a business model that fundamentally conflicts with your values, you're going to have a hard time, right? Either you betray your own values or you become irrelevant. And so when we thought about it, we said, look, we've seen the world of social media, the consumer world, it really seems to, encourage engagement, even addiction, the slop we've seen with AI video models. It's like, what's going on is it want to maximize the number of minutes that you're paying attention to, because that's the advertising revenue-driven incentive. Whereas if we look at enterprise, look, we want to make these models useful to people. We want to use AI to cure diseases that we couldn't cure before, right? Well, that's working with biotech, it's working with pharma, it's working with academic research groups. All of those are enterprises, right? We want to use AI to to make energy cheaper and more efficient. That's all enterprise. And so I think it served us well to have this business model that largely aligns with our values.
Soon after Claude Cowork was released, $285 billion in market value vanished overnight. Traders called it the SaaSpocalypse.
This kind of white-collar wipeout story in the software sector, terrifying.
Some of those are down for 9 days in a row, so clearly the tension is building.
If AI continues improving at this pace, how much of traditional software gets replaced and how fast?
I think with AI, the pie is getting bigger, right? So the existing incumbents may be smaller in relative terms. Some of them may go down in value. Some of them may even go out of business if they don't adapt in the right way. But I would guess that the software industry gets larger, not smaller, although there will be some big losers. Those who don't kind of see what's coming, who don't identify the moats they have, they're going to have a really hard time.
And you can see that conversation in full on a new episode of The Circuit with Emily Chang. Subscribers can access it on the terminal and at Bloomberg.com from 1 p.m. UK time today. And for more on the tech outlook here in Europe and London's role in the AI race, do check out the latest episode of Bloomberg Tech Europe. Catch that at 8:30 a.m. London time this Friday. But coming up right here on Daybreak Europe, as the sole supplier of EUV machines powering ahead advanced chip manufacturing, ASML looks like the quintessential pick and shovel play on the AI boom. But investors aren't so sure. We'll tell you why next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. ASML's ascent to fresh record highs has boosted European markets, but it's done little to improve what is the chip-making machine company's cheapest relative valuation in years. While the Dutch firm's shares are up some 64% this year, the gain has lagged that of broader US semiconductor sector, which has been lifted by soaring demand for AI tools. Dasha Afanasieva, Bloomberg's Amsterdam bureau chief, joins me now for more. Morning, Dasha. I mean, it seems like investors' main concern is that however strong demand is, ASML won't be able to monetize it. Is it more a case of won't than can't, though?
That's right. So ASML is often referred to as a monopoly. And even though it is true that it is the only company in the world that makes extreme ultraviolet lithography machines that are crucial to the big AI boom, it's actually competing with other parts of the sophisticated chip-making technology supply chain, which means that companies decide to allocate money to each of these different stages. And investors are concerned that, in relative terms, ASML's EUV machines aren't actually getting the boost that other parts of the supply chain are, like etching or advanced packaging. The other issue is that they're actually not increasing prices, despite this kind of much coveted, almost monopoly style sell position. They've decided not to raise prices. So it's kind of like they're sitting on this amazing tool that's the only of its kind in the world, but they're not quite capitalizing it into this kind of runaway market success that they might want to see.
Which seems so strange. But then on top of that, you've also got worries about whether ASML can actually meet demand, right?
Exactly. So that there have been worries about capacity constraints. So can it ramp up production quickly enough? Because these are extremely technically advanced, sophisticated machines that require super expensive technology to make. It's not, it's much more sophisticated, compared to, say, a shovel and pick, if you go with that analogy. And the capacity issue that, they're getting a new site online in the Netherlands, and that's taking longer than they might have hoped. So there are these long-term capacity constraints. But on the other hand, some of those have eased, because Bank of America recently said that actually they're going to be able to sell 90 EUV machines, up from 48 in the year prior. So that's a pretty hefty jump.
Dasha, thank you for bringing us that story. That's Dasha Afanasieva, Bloomberg's Amsterdam bureau chief. Thank you very much. Well, coming up on the programme, we're going to be talking markets with Pilar Gomez-Bravo from MFS Investment Management as we look at futures now pointing south here in Europe. Euro Stoxx 50 futures flat to the downside. S&P E-minis down 0.5%, following the moves we've already seen in the Asian session. The NCI Pacific Index down 2.6%. Two headwinds this morning: geopolitics and tech. More next. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Oil ticks higher as the US and Iran exchange strikes after the downing of an American helicopter over the Strait of Hormuz. Stocks resume their declines, with tech leading losses in Asia ahead of today's US inflation print. Plus, concerns over the outlook for private markets dominate SuperReturn in Berlin. We'll be hearing from top deal makers throughout the day. Well, a very good morning. Welcome to Wednesday. Here's the picture in markets this morning. And tech is sliding again, weighing on stocks and futures. We've got the South Korean Kospi down 5.8% now, so dragging down the broader MSCI index 2.5%. Nasdaq futures down 0.8% after a choppy session yesterday. We had chip stocks under particular pressure, so the S&P E-minis index down 0.4% now. And Euro Stoxx futures are now in the green ever so slightly, but we have been flipping between positive and negative even just throughout this programme. So in the end, risk appetite remaining fragile. There you go, back to unchanged, just as I am speaking. Now, flip the board over to the cross-asset picture, and you can see how the geopolitics is playing into all of this. Oil climbing again, just a touch now. Brent at $91.50 a barrel. That, of course, though, not helping stocks. And counterintuitively, perhaps, because of the US-Iran clashes, we have gold slipping, now below $4,200 an ounce, slumping deeper below that 200-day moving average because of the raised inflation risks and the possibility of rate hikes. Now, taking that to the bond space, Treasury yields have been climbing in advance of the US CPI print, expectations mounting that the Fed's going to have to hike rates to fight inflation. The 10-year now at 4.53%, and the 2-year, in fact, at its highest in over a year, I believe. Now, let's look at your front pages this morning. The Financial Times leading with the latest exchange of fire between the US and Iran after the downing of an American helicopter over the Strait of Hormuz. The Wall Street Journal, meanwhile, features the results of the Democratic Senate primary in Maine, one of the party's key targets in this year's midterms. Political newcomer Graham Plattner winning despite controversies that have plagued his campaign so far. And then here in Europe, in France, we look at Le Monde. They're also on the geopolitics, leading with Iran, a headline which says that Donald Trump is determined to strike Iran to preserve his credibility, which, of course, partly comes back to those midterms. But you can get a roundup of all the stories you need to know to get your day going in today's edition of Daybreak, which terminal subscribers can find by going to DAYB Go. Well, let's turn back to the markets now. Bond traders piling into positions targeting multiple Fed hikes in the coming months, with some looking for a move as early as September. Now, the flurry in activity comes off the back of that surprisingly strong US employment report on Friday. Investors also now waiting for May's CPI data due later on today. I'm pleased to welcome to the studio Pilar Gomez-Bravo, Co-CIO of Fixed Income at MFS Investment Management, for some analysis. So thank you so much for coming into the studio. Friday's jobs report seemed to change the market narrative. Did it change yours?
I think it was undoubtedly a very positive report. I think if you go into the innards of the report, you can start sort of seeing that there's some areas, obviously government employment was high. Healthcare continues to surprise us, being high. But I think the one thing that kind of paints a slightly different picture is that when you look at sort of average hourly earnings, that did not go higher, unemployment rate did not go lower. So, yes, I think that if you look at it in the non-farm payrolls per se, it was certainly a very positive number, not just on its own, but also because you've seen the last 3 months being very positive. So it's not like a one-off. It has been a trend that's been quite positive. Other employment reports maybe mitigate that a little bit. But we do definitely want to sort of see kind of obviously what the CPI numbers are going to be today to either confirm that or not. But undoubtedly, I think that sort of spooked the yield markets quite a bit.
Yeah, what would it take in the inflation data today and in the months ahead for you to see Fed hikes before the end of the year? I
mean, I think you need to see headline inflation really start translating more significantly into core CPI, right, and core PC, which is what the Fed looks at. That can take a little bit of time. I think if you look at sort of obviously what Brent futures, you were talking about that earlier, are doing is the markets, and even if you look at TIPS break-evens, right, in the inflation markets, you're not seeing the markets particularly concerned about this being a very persistent inflation shock. But that's yet to be seen because, as you mentioned also, we still are waiting for a resolution on the Iran conflict. So the more that persists, the more the physical bottlenecks will start hurting. So whilst the markets are relatively sanguine yet, yes, there's going to be an increase in inflation expectations. You might get to year-end inflation, core CPI, that's certainly going to be above 3%, maybe 3.1, 3.2. I think from there to sort of get to much higher levels, you need to have that persistent inflation shock that comes through an oil bottleneck and also memory chips, right? I mean, that's also very expensive. So certainly that the tail risks are for higher inflation. And I think that the crux is going to come in September, October. You're going to have a confluence of risk factors, either oil, rate hikes, and potentially having to price in more. And at the same time, obviously, these wonderful IPOs that we're getting on the equity markets that are going to crowd out capital, right? So those three factors are not as impactful today for Fed. But certainly as you get into the next 2 or 3 months, I think that certainly the Fed's going to be tested and the bond markets and equity markets will also be tested.
But also we've got a new Fed chair, right? And we don't know what his communication style is going to be. There are rumours, Ben Ram was highlighting this earlier, that he might do away with his own dot when it comes to the dot plot. Maybe he'll want fewer press conferences throughout the year. Is the market ready for that? What sort of reaction would you expect to see?
I mean, I think that's certainly kind of the case that we would expect his first meeting to be more about how he intends to carry forward with regards to the processes and the protocols that the Fed has established. I mean, the Fed is a slow-moving animal as well, so I think that it's going to be a gradual process. If he wants to sort of create new projects for revisions of sort of standard procedures, it's going to take some time. I don't know that he'll refrain from a dot or not, but I certainly think that the most important thing for us is that the easing bias will be kind of like eliminated, that you're going to have a more neutral stance. And I think it's going to be about what he does with the press conferences at the end of the day, whether guidance, is going to be coming forward or not.
So right now, where are you thinking the 10-year ends the year?
I mean, I think the 10-year has been surprisingly steady around that 4.5%. So I think it's still going to be within a range. I think that if you sort of get higher than 4.75, 5%, you're going to have a ceiling. Look at the 30-year. The 30-year barely can break 5%, right? So I actually think a lot of the volatility is actually at the front end, which is where it should be, because that's where you're pricing in central bank action. I think that the more the central bank hikes, the less pressure should be on sort of the long end of the curve, right? Because in theory, you're controlling inflation expectations lower. But yeah, I think that you might end up surprisingly close to where you are today.
5.01% where we are on the 30-year right now. I also just want to take us over to Europe, though. Can the ECB hike as many times as price when you've got this growth backdrop?
I mean, I think the ECB is sanguine about, look, we need to hike to protect inflation expectations from going higher.
But some are saying one and done.
And however, I think that the path might be one. Let's hike a couple of times, insurance hikes, as they call it. And if we do have a very negative growth impact, then we'll cut rates again next year. So they're a more pragmatic approach of sort of saying, look, we need to do something now, because obviously they're at the forefront of higher inflation. They are really true to that target of 2%. They don't have an employment mandate. However, I think they're also ready to cut. I mean, remember that it was the one bank that sort of came down quickly to that 2% target level of neutral rates, whereas the Bank of England, the RBA, or the US Fed were in theory still planning more cuts, so they were a little bit late to the game.
But let's say that the messaging on Thursday isn't as hawkish as perhaps expected. How much do we see yield dropping as a result?
I mean, I think it depends on where you are on the curve. I mean, we have these wonderful meetings where we bring all the portfolio managers together and the rate strategists. And I think that it's a question around the tail risks, right? If you look at the volatility in the front end, it's very high. You'll have times where, depending on kind of the noise on the Iran war, you will set 20 basis points moves in the front end. But again, look at that bund. Look at that 10-year bund. It's been around the 3% for a long time. So I think that if there is if there's a more dovish interpretation, I actually think that the markets might worry because the Iran conflict has not been resolved. So in fact, you might perversely see a sort of higher level of rates in the long end if the ECB becomes super dovish all of a sudden. I don't think that would be taken positively whilst you still have core inflation above 3%.
OK, really interesting. I just have to finally end on the UK.
Yes.
Of course, we're looking ahead to that Makerfield by-election. Are we just waiting for gilt yields to spike if Burnham wins?
I mean, that's actually kind of like the consensus, right? That sort of this leaning towards a much more left-wing type of fiscal policy would obviously put at risk the fiscal rules that the UK has sort of abided by for quite a long time.
Even if he says he's going to stick to them.
Even if he says, well, you're in campaign mode, right? So but I also think that you need to be realistic. I don't really think that there's that much fiscal space, frankly, that even he could move with. So I think if you do have a significant move up in yields in the UK, we might sort of see that as an attractive opportunity, frankly, rather than not, because I really do think that the UK is somewhat constrained with regards to even the the politics of what might be realistic once, you're in power. So that's something to watch. I think the Bank of England is more interesting because they're in a bit of a pickle. They might not be as adventurous as the ECB in terms of hiking rates, even though, again, they do have certainly some inflation pressures like the U.S. does. But, I think, what at the end of the day really matters is that there's amazing opportunities in fixed income. Yields are high. Yields are higher than the earnings yield in the S&P. And therefore, if you're an active investor, when you think about all the central banks that are coming, and we haven't even spoken about Bank of Japan. Yeah. I mean, I know it's fixed income, but it's exciting. Yeah. And so there's a lot of things that are going to happen over the next 3 months that are going to be really relevant, not only for fixed income investors, but for investors in general. And again, especially around sort of risky assets as well.
All right, well, we haven't got the time to go to the BOJ. We'll do it next time. Pilar, thank you for visiting us in studio. Pilar Gomez-Bravos, Co-CIO of Fixed Income over at MFS Investment Management. We're coming up on Daybreak Europe. Are the returns still super? Private capital's biggest names descend on Berlin for SuperReturn, and we'll be hearing from the 6th Street Co-CIO Julian Salisbury next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, much of the private capital industry's top brass is convening in Berlin this week at the annual SuperReturn conference. It comes as the private markets boom shows signs of faltering amid unprecedented withdrawals from retail-focused funds. Bloomberg's Danny Berger's on the ground for us in Berlin, a long-time face of Daybreak Europe that viewers will remember fondly. Danny, who have you got with you?
Lizzie, thank you so much. I missed being on your airwaves this early in the morning. Clearly, you can't get rid of me. I'm so pleased that I'm here at SuperReturn and here, nonetheless, with Julian Salisbury, the co-CIO of 6th Street. Julian, thank you so much for joining.
Great to be here.
Thank you you're the first victim, bright and early. Hope you're awake.
I don't know why I got the graveyards.
Because you're the most important person, so we're starting out on a strong note. And look, it's kind of funny because maybe 2-3 years ago, the word of SuperReturn was, golden age of private credit. And now it's withdrawals. There's a bit of calm. You have Cliffwater starting again. You have Blackstone. There's still these fears. Software hasn't gone anywhere. I just wonder where in your mind we are right now. Is this still an industry that's going through some growing pains and stress, or are we kind of on the back end of it?
Look, it depends on the platform that you're operating on. For us right now, we've never seen such high levels of activity. It's actually a tremendous environment for us. The fact that you've seen withdrawals in certain types of vehicles, people who use short-term liabilities to invest in their companies and their platforms, it's not how we operate. We have long-term, drawdown, flexible capital. So when we see an operating environment like this, it's actually better for us. These kind of tight upward to the right capital flowing, and it's actually much more difficult. A kind of more complex environment like this, where you're seeing technical pressures, people pulling back in terms of their own capital. It's a great operating environment for us. It's never been so busy.
So is this a unique 6th Street thing then? And what does that mean for the rest of the industry? Is your gain other people's pain, I guess, is my question.
I wouldn't put it that way. It's like when the industry overall grows, that's good for us all. I mean, growing private capital markets, growing economies, growing businesses. There's some great success stories we can talk about here in Europe where we've been able to find growth. But I'd say, it is typically better for us when, the markets are not just like grinding up and to the right all of the time. So moments like COVID, moments like the rate hikes at the end of 21, where you see stresses around industries, whether it's real estate or software, these are typically better environments for us to be able to use our conviction around particular themes and sectors and not be worried about what other people are doing and lean in heavily.
In the rest of the market, though, there is this real conversation happening. Is it headlines or is it something deeper? At this moment, is there a deeper stress? Are marks honest right now, Julian?
Look, here's the reality. When an industry grows as fast as the private credit industry has grown, it's like doubled over the last 5 years. It's likely going to double again over the next 5 years. You're also coming off an environment where, frankly, default levels were at, historic lows. So when it's natural that you would see an uptick in defaults. It's natural you're going to see an increase in nominal defaults because the industry's just doubled. So you're going to see an increasing number of defaults and headlines associated with that over the next few years. But if you look at the true underlying health of the businesses, certainly for our portfolios, I think for many people's portfolios, companies are performing just fine. But doesn't mean you aren't going to see some accidents along the way. When things grow this fast, typically some things break.
The other thing that's growing very fast right now is AI data centers and the involvement of private capital in it. I was listening, John Gray was speaking at a conference earlier this week basically saying a great way to play AI is to buy Blackstone shares because we're becoming an AI investing company. Is that another aspect, another asset class, that it grows so fast that surely there are accidents along the way?
Look, inevitably, yes, but for now, we're seeing tremendous growth signals. The investments we have in and around the space are just continuing to outperform our expectations quarter over quarter. The sheer capital need is just tremendous, whether it's equity capital for development platforms, equity capital for stabilized assets, financing of the data centers, leveraging the people financing the data centers. The capital needs are of a magnitude nobody's really seen before, certainly at this scale, and that creates opportunities. I suspect there are going to be, there will be generational great businesses that emerge from this period of time. But yeah, when things grow this fast, inevitably there'll be some losers along the way, and at some point in the next 2, 3, 4 years, there'll likely be some kind of shakeout.
Well, one of the points, I believe it was Oaktree made, this fear, and Double Line too, this fear that you have a loan, it's maybe 5 years, but within that, the technology within it goes it's no longer applicable. It basically gets old. I wonder how you're thinking about the life cycle of these loans, that maybe they're attractive now, but what happens on the back end?
Yeah, look, it's a great question. It's something that comes up in every investment committee discussion we have around the durability and sustainability of the revenues for certainly software businesses. I mean, I don't think it's anything particularly insightful, but it depends how ingrained the business is.
I mean, not even the software, like a data center, the actual chips in the data center need to be replaced.
Yeah, of course. Look, there's been a replacement cycle for chips for many years, yes. Typically, we're all used to our iPhone upgrades, our computer upgrades, our laptop upgrades. There'll be a replacement cycle. I think that's largely factored in. People understand that that's a challenge. I mean, look, the longer-term debate the debate that's been coming up recently is, a data centers in space ultimately going to be the source that disrupts all of these terrestrial data centers. But I still think that's some ways out, and the need for the terrestrial powered land is going to persist over a medium and long term.
Lucky for us, we all get to debate and talk about data centers in space because we get SpaceX this week, so it's a topic of conversation. There's so much capital flowing to IPOs, to data centers. At the moment, the supply-demand dynamic has been capital needs to be put to work, and it's kept spreads really tight. Does that change at all with just the amount of supply coming online that's competing for a lot of the same institutional capital?
Look, it's a great question. I think over the next couple of years, I think you're going to start butting up against concentration limits against individual borrowers or sectors as a whole. But the financial services industry is pretty good and adept at evolving and adapting to that. So, what started out as data center specific financing, people have now been tapping, the insurance market, the CMBS market, the leverage finance market, the bond market, the IG market. So there's a lot of capacity out there, at least for the next few years. But ultimately, people are going to start butting up against industry concentration limits. The other thing that I think is super exciting is, how a lot of this capital is going to get recycled as these IPOs happen. It's going to free up a lot of capital and that's been built up and returns that have been generated in the private markets, and how much of that's going to get recycled back into the next generation of growth businesses. I think there's a tremendous opportunity for that market.
What happens? So if we start to breach concentration limits, and these things are coming back up again, it's not the first time investment, the loan is coming due, what have you, people are looking at selling some of their data center assets. Are there enough buyers out there to continue this cycle going, or do we reach a problem because so many people are jumping in and all the big pensions and all of the big insurers are already in this market now?
Yeah. Look, I think this is a real challenge that we're going to have to work through over the next couple of years. And specifically right now, I think there's a lot of demand for lending to data centers with long-term IG offtake contracts, and certainly a lot of demand for people to lend against those loans. There's certainly a ton of demand right now to invest in development platforms where you're making incredible development economics, developing data centers at a 10% yield, thinking you can sell them at a 6 or a 6.5% yield. The longer term challenge is going to be the stabilized takeout. How do you, ultimately a long-term market needs to evolve for the purchasing of all these stabilized assets, a REIT market essentially. And there are early signs of that happening, but it's still in the, it's still in the very early days of that. And that's people who are going to be willing to take what you referenced earlier as the longer term, residual value bet on these properties.
All right, Julian, we're going to have to end it there. Thank you so much for joining. Appreciate your time this morning. Great to see you as always, Lizzie. Of course, that was Julian Salisbury of 6th Street.
Danny, thank you very much. That's Bloomberg's Danny Berger with the 6th Street Co-CIO. And Bloomberg TV will be live from SuperReturn in Berlin both today and tomorrow with exclusive interviews just like that one with some of the leading figures in private markets. So don't miss Danny's coverage. Now, to some other top stories that we're following for you this morning. Bloomberg has learned that the UK Treasury is resisting calls to speed up an increase in defence spending days before the government unveils its long-awaited military investment plan. We're told that ministers are still debating whether to commit to reaching defence spending equal to 3% of economic output by 2030. The target is currently set for the next Parliament. Defence Secretary John Healey and military chiefs are pushing for a faster timetable. Elsewhere, a Florida trading company says it's in advanced talks to send Cuba the biggest cargo of US fuel since the Eisenhower administration. Vanguard Energy is gearing up to export 250,000 barrels of diesel and gasoline. Well, those are some of our top stories from around the world. We've got plenty more coming up for you on Daybreak Europe. We'll frame your day ahead with some terminal charts. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:56 a.m. here in London. And I just want to set you up for the key risk event on the docket for today, which is, of course, the US CPI print. These are the expectations, a tick up from 3.8% to 4.2% at the headline level year on year. But how often are we surprised by the CPI numbers, I hear you ask? Well, flip the board over, and our macro man, Cameron Cries, has been crunching the numbers for us. You can see that at the headline level, we've seen more upside surprises regularly happening. But at the core level, you tend to see downside surprises. That's the blue line here. Of course, all of this is crucial to Fed expectations, and these data go back to 2012 when the Fed formally adopted an inflation target. So that number coming up later on today. The opening trade is coming up next. Anna Guy and Tom will take you to the open. This is Bloomberg.